And I'm saying recession, not a slowdown, not a pause, not a kerfuffle, recession. Trump comes in, and although he's talking that he's in a big, beautiful budget and it's all going to be great and the biggest tax cut ever, he has actually tightened more in a shorter time than probably any presidency since, actually probably in history. The macroeconomic impact of tariffs is a fiscal tightening because of the greatly increased tax bill. You got to come up with about, it looks like 400 billion corporate profits to make me look ridiculous, or even to dismiss me. The door is already shut, and I would say, even to be a little abrasive, that you're pretty foolish to be long equity right now.
This episode is brought to you by VanEck Semiconductor ETFs. You'll hear more about the VanEck Semiconductor ETF, ticker SMH, the largest semiconductor ETF, and its newer VanEck Fabless Semiconductor ETF, ticker SMHX, later in the show. The Blockworks Digital Asset Summit, crypto's premier institutional event, is back in London this October 13th to 15th. You've got top speakers from BlackRock, Circle, Coinbase, the UK Parliament, and Athena, all under one roof. I'll be there as well, hosting a live forward guidance episode with Quinn and a few others. So if you want to see us record in the flesh or meet some of the other legends from the forward guidance community, this is your shot. Notable macro names like Michael Howell of Cross Border Capital and Jeff Park are already confirmed, with more coming. There's also a VIP dinner on the 13th that will sell out fast. That's for speakers and VIP ticket holders only. It's at Old Billingsgate in London. Use code FORWARD100 for £100 off. See you there. Nothing said on forward guidance is a recommendation to buy or sell any investments or products. This podcast is for informational purposes only, and the views expressed by anyone on the show are solely their opinions, not financial advice, or necessarily the views of Blockworks. Our hosts, guests, and the Blockworks team may hold positions in the company's funds or projects discussed. All right, everybody, welcome back to another episode of Forward Guidance. And joining me today is repeat guest, George Robertson of the Monetary Frontier. And George, I think you're the most requested guest on the show right now. I had a lot of requests to get you on. You've had some evolving views.
Shit, feel like you shouldn't have told me that, because now I'm going to take care of this, okay?
There you go. Yeah.
I got to start charging you.
Yeah, exactly. But no, it's great to have you on. You've had some evolving and bold theses, both as, we had you back on here, I think in 2024, and you're one of the loudest bulls, and you're correct on that. And now I would say you're one of the loudest bears. So George, we need to figure out what changed. We need to figure out what's going on and dig into the data. So I'm excited to have you on here.
Okay, great. Well, first, always a big compliment that you would spend time with me. So I really appreciate the invite, and I hope it can be useful. The nature of how I look at the markets and my timing, as shown by my P&L year-to-date, sucks. I'm just dismal in terms of sentiment and triple tops and reading the technicals and all that good stuff. And the market is definitely being led, I think, by that type of mentality. That's not to diss it. Commodity guys have been doing it for centuries. But it shows with the introduction of crypto and other very hard to find intrinsic value assets, which are dominating right now, be it NVIDIA or Bitcoin. People have depended upon sentiment and what's the market leadership going to do? And I got an insight track that if I see them appear at 8 p.m. or whatever, then I know it's going to go down, or triple tops or what have you, whatever your sauce is. And that is something that I'm not very good at. Where I've come from, and it comes back from having a roots in bonds, is that you watch the flow of funds. Every asset has a liability. Assets less liability equals the equity, and that could be conceptual, as currency value, or it could be actual, very obvious, such as the equity value of a company. All these asset liabilities make up the economy. In monetary land, it's called Godly tables, where there's no creation of money without a creation of liability, either in the Fed's or the system bank's sheets. And as this waxes and wanes, the equity is created or are destroyed, and you get a sense of the market. And this can be applied to any asset. And as it's put together, it's stitched together in that's the GDP tables, or what's called the NIPA tables from the Bureau of Economic Analysis. This is somewhat, when it's really working, it's somewhat stately. It can be current. Often it can give you insights as other people are dealing with sentiment and technical indicators. You can often be ahead of the pack, but as far as your P&L goes, often early, which can hurt. And so what's happened here is that people are not paying attention to the actual value, the actual flow of funds that Trump has brought into the scene, and they're massive. And in particular, what's caught my eye, I'm sort of grumpy about Trump's sort of sloppy ideas of like how finance should be organized, the political interactions. We can go on, but that's probably not what we're into today.
And before you pull up those slides, I just do want to provide a little bit more context there on where you came from. So you follow the flow of funds. Last year, correct me if I'm wrong, but to characterize what the flow of funds were telling you was that we are in this regime with a very dominant fiscal impulse, Bidenomics, et cetera, that was leading to higher end GDP in a regime where, yes, we had, the Fed was still showing up every month or so and changing or hiking or cutting interest rates. But overall, the monetary impulse was very subdued. So we're in this regime where there's this large fiscal impulse. So it was leading to an economy that was hotter than everybody expected. At that time, everybody was expecting a recession. You came out saying, no, that's completely unlikely. It's actually likely the opposite. That was largely correct. And now the flow of funds, driven by these changes in Trump policy, which you're about to get into, is leaning to a negative impulse, right?
That's right. And also I have a great cheat, or hack, which the Federal Reserve and the monetary system is deliberately, it's obviously complex. And people start and end and often never leave the monetary policy of the Fed in terms of their analysis. Fed's doing this, Fed's doing that. They said this, they said that. Powell coughed, all sorts of stuff. And I realized by about 2015 that as far as a flow of funds analysis, which will be and has always been the economy, with the Federal Reserve only adding a bit of governance to it, there is no Federal Reserve. In other words, the Federal Reserve has not impacted the flow of funds, but for sentiment in terms of like expectations, which is like waiting for Godot. It's never happened since 2014, 2015. The Fed has had no impact on the economy. There's a lot of talk, a lot of attention. Trump is like making that his focus. Everyone goes on and on and on about the Fed, but you can't find a major input or drain from the economy from the Federal Reserve. And this has been like a decade plus now. So with that cheat, I don't have to deal with the Fed. I can just cut to the chase, and I think I have a very much more clear and much more robust depiction of the economy and how things are going about. With that in regard, that handicaps what I've been saying to date, and I also think it gives me a lot of confidence in what I'm about to depict.
Okay, so yeah, let's pull up your slides and walk us through what the flow of funds is telling you about the economy today.
Now, the first slide, you should have in front of you monetary impulse rolling annual cumulative. What this shows is having dissed the Fed, I'm also, here we go, we're going to get into it. This is the Federal Reserve's add or drain from the economy on a rolling annual daily. That means each one of these data points is the cumulative year-to-date impact that the Fed has had on the economy. Now, this is very broad strokes. They could make all sorts of various bank macroprudential type of rules and regs that could either multiply this or decrease its impact. But I think this is good enough, especially if we're watching the change in terms of figuring out what the Fed's doing. And I'm going over this slide to begin with to basically to sideline them, to show that it's not much importance. And you can see that the Fed has been in a range of about, $1 trillion plus or minus in terms of what they do to the economy. When they're minus, that i.e. the Fed is draining, it's inadvertent. It means that the system banks are destroying money, if you will, are decreasing their loans because they're worried, or they think for certain we're going into recession. And sure enough, we're in a recession. And you can see this in 2009, where we dropped as low as a drain of 500 billion rolling per year. Also, you can see in COVID, it got up to $1 trillion. It was a big hit. And then you can see the response that the Federal Reserve has done in terms of goosing loan creation and getting money into the system, transactional money, and also support our stimulus into the system. And they never really got past a couple $100 billion after 08, 09, despite all the fanfare about Yellen and ZERP and all that stuff. They really were not much about anything. And if you compare the right after 2008 to 2004 to 2008, the Fed was very involved. And then after the GFC, the Fed turned from worrying about monetarism just to macroprudential, the Frank rules and so on, where they're just basically concerned only about the stability of the banking system. GFC scared the hell out of them, and they thought they were going to lose a couple banks. They didn't. So from 2000 GFC on to right till about COVID, the Fed's a no-show. It's a very light hand. There's a bit of a as the Fed starts to try to normalize, like put Fed funds in a theoretical relationship to the GDP going up or down. But then you can see that the Fed actually starts to pull money out of the system. A cynic might say it's to anticipate Trump or to make things difficult for him. And then Powell says he's going to try to normalize, but basically does nothing. And then, of course, we get whacked by COVID. And then the Fed just throws everything and anything they can think of into the economy. And what's surprising is how little the Fed actually did. It was only about $1 trillion ad, which is not too far from what they did just as a norm through the aughts. And then the COVID comes in hard. We just looks like we might enter into depression. Everything stops. Now it should be remembered that this was imposed on the U.S. economy because it was illegal to work. So the economy, the Fed does everything and anything. And again, it doesn't really peak much past $1 trillion ad, and by this time the Fed, the economy being toward 30 trillion, it's nothing. And then the Fed tries to back off. They pull down. We end up with Silicon Valley. And from here on, from about 23 on, the Fed just sort of says, okay, we're out of the game. And if anything, we're just going to try to accommodate the economy and become a non-issue, especially with looking toward Trump too. And that's what they're doing, a non-story. Now I went spend some time in the monetary to try to show in the subsequent slides that I'll show that the Fed's a non-issue, and they're certainly not deserving from a macroeconomic point of view, and therefore the market all the respect and attention and focus and arguments that they receive.
Yeah, I feel like that's one of the big lessons somebody like yourself has given a lot of people, macro listeners, is too much focus on monetary, not enough focus on fiscal. And I know fiscal has become a large portion of your framework.
Right. And this is just a close-up of the previous slide. I won't belabor it. And then this is trying to hone down. This is 2025. This is the era of Trump. And I would say that perhaps cynically, that Powell is just trying to get the hell out of the way of Trump. He just doesn't want anything to do with the guy. They're easing slightly ongoing which given a still a 4.5%, 5% GDP, and also with inflation that is stubbornly not going below 3%, is sort of strange. But the Fed's just a non-event for this year at least. Now, fiscal, wow, a completely different story.
Breakthroughs begin with semiconductors. With over $23 billion in assets under management, the VanEck Semiconductor ETF, ticker SMH, is not only the largest semiconductor ETF, but it has also outperformed the next largest semiconductor ETF. It is built on an intelligently designed and constrained index that includes the whole sector stack, from design to manufacturing. Historically, this unique construction and methodology have helped SMH outperform its closest ETF competitor. Check out the table below. Go to vaneck.com/SMHFelix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
This is Fiscal is basically a function of Congress. They hold the purse strings, at least the Constitution says they do, although Trump's challenging that. They go up and down, and the Fed is basically providing an offset to where they're perhaps overly tight. That goes into the .com, and then they're putting money into the system after giving the employment reaction to .com. We come into the GFC, and the Fed and the Congress just says, "Hell, let's just throw some money into the system." It's surprisingly not much, just about $1.5 trillion. My thought is that Obama was actually rather austere. It comes back down, and it basically is neutral, and then we hit COVID. And boy, when we hit COVID, the Congress goes berserk, the fiscal goes nuts. It goes up to $4 trillion, and it should be interesting to note that, and this is the rolling cumulative add of money into the system coming from Congress, coming from the federal government. That this is actually the so-called K economy. There was actually an ad of about $7 trillion gross that hit the economy from COVID, of which the netted out to $4 trillion because those that did pay taxes were not really the recipient of the lion's share of that stimulus. It went to guys who were just hanging in there, normal people, average people. So this had an outside effect of just the $4 trillion. It probably had in past lives, it probably had the effect of like a sudden add, and this is only, good gosh, this is only in a year's time, of about $5 trillion, $6 trillion in terms of macroeconomic thought. Well, COVID passed by, and all the various programs had a short lifespan. So the fiscal ad dropped very quickly into 22. People started talking about recession. And then Biden, sort of enjoying his job, says, we're going to carry on with green, with various industrial policies. And off we go back up to a pretty loose fiscal ad, and especially when you look at it from, over time, up to $2 trillion. But then we hit Trump. And Trump comes in, and although he's talking that he's in a big, beautiful budget and it's all going to be great and the biggest tax cut ever, he has actually tightened more in a shorter time than probably any presidency since, actually probably in history, if you look at a percentage of GDP. And what this is that Congress has stepped aside, and they're letting Trump run the whole show. And this is almost dollar for dollar. Not, first of all, it's just the scare factor. He's just scaring the shit out of the economy. And then the second thing is that he did cut 100,000 jobs. There's some carry on, but we're going to see these probably employment numbers coming up soon. And that was a drop, and also anticipation of what the heck is this guy going to do? And then this is tariffs. Tariffs is a tax. It is not paid by China. It is not paid by companies. It's not all the discussion of who pays tariffs is really ridiculous. Tariffs are paid by the importer, period. That's just it. and there might be adjustments for costs, a way to avoid inflationary increases, all sorts of things going on. But the macroeconomic impact of tariffs is a fiscal tightening because of the greatly increased tax bill. I would say about 80% of the tax that is tariffs is paid by corporations. Ford itself is already talking about $1 billion hit to earnings because of the tariffs, and so on. This is a very large amount, and nobody is really, except Torsten Slok at Apollo, start to talk about it, but it looks like he's been pulled away from that. But no one's paying attention to this, and it's about as obvious as
could you just unpack? There's something that we went actually back and forth on, I think about a month and a bit ago, around this idea of, does it matter whether it's the consumer paying it or the corporation paying it? Because as you mentioned, all right, tax increase. So if it's the corporation paying it, I would assume corporate profit margins are going to compress. If the corporate company can pass it on to a price increase to the consumer, that's going to be a price hike for them, therefore less purchasing power for consumer. But you had this nuance that you believe it doesn't really matter which side is paying it. Regardless, when you net it all out, it's a tightening of the economy, right?
Yeah, what that is, Felix, is that I think you're putting together two concepts, two thoughts. One is earnings and profitability, or inflation, and the other one is just transaction. Like here, this is you just imported like 300 million worth of stuff. Your tariff is such. And it's not the importer, it's not the exporter. It is always just the importer. Now, there's small lots, people going to TMU and stuff, so maybe corporations aren't paying all of it. I just grabbed it out of the air. I said that they're paying 80% of it. Paying is a transaction. It's not a concept of earnings. And there is absolutely no argument that corporations have had their tax bill increased by right now it's 200 billion, and it looks like it's on track as most people say to about 300 billion bucks. It is not revenue. It is not a boon to the economy. No one's making any money off this, except it's a tax. Now, it may cause, actually, I'm sure it is. It's causing all sorts of adjustments for prices, and how to get business do. How do I keep selling these Mercedes Benzes, or whatever? But that has nothing to do with the fiscal impact, which is a tax. And whenever you increase tax, you tighten up. You are dropping the fiscal impulse because unless the government is going out and saying, well, okay, we're gonna give a tax credit for anybody who pays tariffs, which I can't find. Well, actually, it's not happening. Then it is tightening up the fiscal position of the country. It is a drop of the fiscal impulse of really massive proportions.
And basically the big headline from here is that due to this huge fiscal tightening, you believe we're in the very early or well underway into a recession now, correct?
Oh, come on, Felix. I've done too much work. Let me have a little more fun, okay?
Okay, walk us through the mechanics, but I won't bury
okay.
Yes, walk us through the mechanics.
You want to speed this up, so let me just jump to the chase. This blue line is monetary and fiscal combined, and it's expressed in terms of GDP. It is a dollar for dollar impact on GDP. Now, there could be all sorts of Keynesian multipliers, like immediate fat times because of everyone's enjoying employment. Actually, it only comes about by employment increasing. But because of like various industrial policy or because of business transactions, more people are getting employed, they're making more money, they're spending more. So it could be offset, but I can't find it. Employment's been flat, personal consumption's flat, disposable personal income, if anything's going down a bit. So this is a dollar for dollar impact on GDP. It has gone from 6% down to 2%. We have had a drop in NGDP, that's nominal, of 4 percentage points in just about 2 months, 3 months. That's a lot. And you just can't come up with any other conclusion but that. If you look at it in terms of time, that's like falling off a cliff. Now, how I put these numbers together, by the way, is you can see they're pretty jagged here. That's because until like some point in 2024, I think it's Q1, this is the daily cumulative that I pick up the daily Treasury statement from the U.S. Treasury. This is numbers. It's not concept. It's not ideas. It's not big, beautiful budget. It is actual fact. This is rubber. The rubber hits the road. This is what happened. Now, GDP, most people have GDP, especially if you're using the Atlanta Fed, as going up nicely. I have worked with GDP, and I've given up on the Atlanta Fed. First of all, it doesn't suit my story, so why the hell do I want to talk about it? But to have some integrity, I've really noticed that the one nowcasting of GDP is coming from St. Louis. The nowcasting that comes out of the New York Fed, it seems a little screwy. But over time, the nowcasting from the St. Louis News Index, and it's something that's beyond my understanding. It's got Bayesian this and that and all sorts of things, but it's not a constantly weighted index like the Atlanta Fed GDP now. It's a bit more topical in terms of like what has been impacting the NGDP of late, and then it weights that news as it comes out. And it calls it news, by the way. It doesn't call it like, money in, money out like the Atlanta Fed. It actually shows that the GDP is starting to creep down. So while extending it, it doesn't capture this. But I would think that, especially if this is a dollar for dollar hit into GDP, that we're going to see a zero GDP by the end of this year. Now, when the NBER goes out and tries to figure out, okay, when did this recession start? I think they're going to come to this point here. And that, to me, means that the NBER is going to say that this started in the third quarter of this year, 2025. And I'm saying recession, not a slowdown, not a pause, not a kerfuffle, recession. Past experience had that a recession started not with the 08, 09 with Lehman, when people were talking and when it was obvious, showing up in the GDP numbers, but the recession started in the fourth quarter of 07. And people seem to have forgot that, or they didn't take note of it. I think we're going to have the same story now. As we carry on with this, and then I have much, it's also interesting to note that this was a sidecar. It's not really part of the explanation of, except if we just want to go into like what's happening right now. The Fiscal sort of in September it picked up a wee bit, but it's also dropped. We're now we're about to enter negative territory in terms of the Fiscal being an obvious drain to the economy. Again, this isn't surmise or secret sauce or my model. This is just money in, money out, flow of funds that I pick up from the U.S. Treasury on a daily basis. Since the Fed is not adding a lot, since the Fed funds rate doesn't do anything, you can see that the total is also dropping. It's only at 2% now, but it's I think these are going to converge. Unless the Fed goes really bonkers, but they seem to be limited by only about $500 billion in terms of what they can do. So I think that the total is going to go towards 0 too as well. Now, while this is happening, this is the RRP, the blue line here. Now, everyone's put a lot of importance and secret sauce in my theory, which is mine, and Elk stuff, from Monty Python into RRP. It's a facility. It's got to be topped off. No, it's not. Yes, it is. It's just bunk. The reverse repo facility put out by the Fed is just to allow the corporation savings, which was massively added to with the PPP of COVID, for somewhere to go for the money market funds. There just wasn't enough, CDs or or various other assets that they could put in money market fund and be assured of not breaking the buck. So the Fed opened up the window and said, okay, various money market funds are now can access the RRP market, and that's what this is. It is just an, if you will, excess savings. And in fact, I have personal excess savings marked off here in red. But this is corporate excess savings, if you will, just money that's not squandered, hidden away off Grant Gaiman slush funds and double Irish, Dutch, that sort of thing. But it's actual money in, money out on the U.S. ledgers, which, what the hell are we going to do with $2.25 trillion? As the economy kept going and as they start to spend this money, the use of the need for the RRP dropped very quickly. And as we got into 2025, we can see that the RRP is flatlined. This does not mean that there's some tightening going on or anything. It just means that the corporations don't have savings. And this makes sense if you start to think about this fiscal tightening that's going on. Corporations are under stress right now.
So George, I just want to ask, based on everything you put here, it looks quite cut and dry. And you emphasize this point that this is data coming from the daily Treasury statement, which I think is really important because that is, real-time actual numbers. It's not a concept. It's not a forecast. It's not a statistical forecast that gets revised 2 months down the road. This is hard data. So I think that's really key for people to understand. And based on the hard data, it does seem quite compelling that we should be in the early innings of a recession right now. But you look at this, I'm curious about two things. First is, what does that sequence look like for how it impacts the economy? Because when you look at, I know you track jobless claims really closely, and we haven't seen upticks there yet. We've seen, recent GDP. You mentioned some of the issues with Atlanta Fed GDP now, but they're at 4% right now, which is pretty wild. You look at equities, they're at all-time highs. So I'm curious, one, what does that sequence look like into the economy, and why haven't markets caught on to this yet? Using a similar philosophy to SMH, the VanEck Fabless Semiconductor ETF, ticker SMHX, goes even deeper, exclusively investing in fabless semiconductor innovators designing AI infrastructure behind the scenes. We're talking high bandwidth memory, power management chips, custom accelerators, and ultra-fast interconnects, the critical components that make large AI models run faster, smarter, and more efficiently. Go to vaneck.com/SMHX Felix to learn more. As always, investments in blockchain technology involve risk, terms, and conditions apply. Do your own research.
Well, if I'm right, or if this is actually a useful depiction of what's going on in the economy right now, we should see employment get a hit. I mean, in the end, that's what it's all about. How many guys got a job? And I have been ready to claim victory and I nailed this stuff, but that has not occurred in terms of an obvious way that eliminates anyone's ability to argue with me or discuss it otherwise. And of course, I see the majority of guys are still pretty bullish, pretty constructive about growth, and some people are actually saying it's reaccelerating. Where the first thing we should see of this impact is the ability of corporations, non-farm payrolls, to hire people. They should cut. This is the year-over-year withholding FICA rolling annual daily. And again, this is from the daily Treasury statement, the DTS. And what this is, the year-over-year growth of this number, which is the rolling annual withholding FICA payment. Now, this is gross. This is before refunds or tax programs or various things like that. And the number is, it looks like it's a pretty obvious trend upwards, but these spots here, I seem to be stretching to look at like a little nuanced data here, are bubbling here. We're not really getting much outliers on the upside in terms of the sudden increase of withholding that we didn't. If we went back to COVID, we see tons of them. we're seeing constant tests where suddenly this week was light, very light. In fact, a substantial drop of withholding and FICA. And if I take it to make a point, and I do it quarterly, annualized daily, this is like the quarterly annualized increase. There was like what you'd expect from a bottoming of a normal seasonality of withholding and FICA employment, indicating that employment is just hit a seasonal low, but it's dropping hard, and we can actually start to see a pattern here. And don't worry, I'm not going to stress this too long. This isn't I've already made the main part of my case. But you can see this starting to I'd say, starting to form a line that indicates that employment's about to take a crapper. And now this is just the latest outlier down, but you can see that although there are outliers here and here and here, the outliers are starting to get much more dramatic on the downside for the withholding FICA. And again, this is like everyone gets their paycheck every other week or every week. This is how much the government has the employer send right to IRS. And if we look at it in terms of peak to peak, we're starting to, if this becomes like the floor, we're actually at zero growth year over year. I'm making a really dramatic case here. So I think withholding is starting to creak. This bears watching. And trust me, I'll be crawling away if this actually does form into a pattern that shows that withholding and FICA has dropped down hard. Now, if it does, then we go back to my favorite chart, which sustained me when I was very bullish and everyone was talking about recession and all, especially at 22-23. Which this is the initial claims, non-seasonally adjusted. Now I organize them this way because I don't want to get into the argument of seasonality. I just want to look down each week and see what's happened year over year. And I hope this is big enough. But the most recent one was a non-seasonally adjusted 181,000 new claims. And it was 182,000 a year prior. Before that, 176, and before that, 169. In other words, nothing. If I am being prescient here, we should see something that we saw in 20, where it suddenly goes from 200 to 252 to 2,000,009. Now, this is legislated like you shall not work as New York shut down. But this is also the way it goes in previous slowdowns. Like if we look at 08, it goes from like 340 to suddenly, 400. So we should see a jump, any week now. I thought it would have already happened to 250 and then 300, and then we're off to the races. So I think this is creaking. I think this is on the edge of a major breakdown. The other place to look, and this goes back to what I originally talked about, is corporate taxes. I watch corporate taxes very closely. This red line is the daily corporate taxes that are paid to the Treasury, to the IRS. This is net, not gross. And this is the red line here, and we had a drop in corporate taxes from $500 billion odd a year, rolling annual, down to 450, about a $50 billion drop. This is like all the gizmos that Trump put forth to, there's bonus tax credits. There's daisy chains where Oracle would give a chunk of money to NVIDIA, who would give it to AI. They just daisy chained around, and they're basically after taxes for investments, trying to crowd it into this year, and that's that drop of 50 billion. However, in other words, nothing anyway. However, this is tariffs as a corporate payment, and it's just off to the races. And this is the total This is the tariffs here. I'm sorry, the blue line, and this is the total of ongoing corporate income tax with the tariffs, and it's just booming, which goes down. So if this carries on, the pressure which we've already seen in the impulses will come about, and we're going to end up with 50, 60, 100,000, 150,000 guys cut, and then there's no argument.
With this much chart and data, like there's nothing for me to refute. It's super compelling, and I guess the big question on my mind now is what is, and I'm sure it's the question you mentioned at the top of your show, how brutal it's been to trade this view on the short side, on the bear side. It just feels like there's just this complete ignorance of this data that you just presented that is compelling. So what do you think is the catalyst to actually make this happen, and how do you navigate that? Is it, an interesting analog to think about is back in February 2020 when it was quite obvious that we're going to go into a pandemic, but the markets kept melting up into all-time highs. And then there was this common realization in March that, oh crap, we actually are. And then it fell over. But it was quite clear to many in February. But if they shorted in February, they were getting steamrolled. Is it a similar situation?
This is the trouble of being a fundamentalist, I guess. Although in the end, it always stood me in good stead in terms of keeping a job and making money, while other people, died. It's a natural case for positively convex, i.e. options, put options. The trouble you got there, and this is my excuse, is that the out to about, say, 2 months, Citadel and the like own the option market. They just it is wherever they want it to be. And they do constantly dynamic hedging for starting with their zero trade date to expiry options down to to 3 weeks, a month or so, to offset their option boxes, which are basically trying to harvest, or are harvesting via volatility, those who are gung ho and just all psyched about what Bitcoin's doing and all the bulls. They really don't care about direction that much, just as long as they can keep it within a range. And they just drop vol all the time. They're like a toll gate. Anyway, I walked into that. I walked into it originally in 22 because that was my bullish expression, and that didn't work out too well until I just went long JP Morgan and sort of stopped thinking too hard. That worked out really well. And now I went out and shorted S&P puts starting in July, because I thought these numbers are so obvious, and it's so obvious that tariffs are a tax that there's going to be a very quick coming to senses, and boy, I'm going to make a lot of money. Well, I didn't. My 2 and 3 month options became 1 month, and Citadel had no interest in helping me out. And everyone else was all sorts of excited about, Bitcoin went up to 116, and Trump and company were doing everything they could to talk up the market, the tariffs as revenue. So, I died. I laid off what I thought was a very reasonable, but a significant amount of speculative money. I carefully went and put all the money that I'm going to need to live on, say 5 years from now, into places I cannot touch. But nothing happened for me except I lost all my premium. Now, I think what's going to happen is, first of all, then I've gone out and this is just too compelling from my point of view. So I'm back at it. And I think the optionality's got to be longer tenor. And I think we need an event. I think that the event probably will be the Supreme Court. And I think the Supreme Court, based upon everything I understand about Coney Barrett and Roberts and the whole crew, but for the two very reactionary conservatives, is that they're Federalists. And I think you got to be dumb and blind not to see that Trump is trying to rewrite the Constitution informally, and that's neither good nor bad. Maybe he should. but he is trying to rewrite it to what's called a unitary executive. That means that all Congress does is decide how much, and then the president decides when, how, and who does it. And they can do it from week to week, month to month, or whatever. That's the firing of some of the key staff. That's the impoundment of some money. I don't think I'll send this to NIH, even though that Congress said I should. In fact, I think Congress is full of it. So I'm just going to do what I want to do. I'm going to go set tariffs, even though they're foreign policy or tax, without even consulting Congress. Why? Because Canada is like the biggest fentanyl distributor. Everyone knows that. They're trying to kill Americans. Canada's our enemy. So it's an emergency. So therefore, I'm going to clobber Canada with tariffs. Same with China. Same with Bavaria and Germany. It's bullshit. It's complete, outrageous, against the Constitution, and Supreme Court's going to rule them down. I think so. When that event happens, today they already refused to give a stay for the removal of Lisa Cook, and when Supreme Court acts, I think Trump is just left with nothing.
If you think this is mostly driven by tariffs, but you think the Supreme Court is going to invalidate it, would that then invalidate your view and then you would be bullish? Or do you think, the writing's already on the wall?
Because the car wreck has already happened. We still got untangled bodies, and we got to set things right. We got to hose down the highway from all the gas that was spilled, that wasn't burnt. It's going to be at least 3 to 6 months mess. It's going to be chaos. The other thing, too, is that a lot of what Trump is doing is not tariffs, of course. He's decided that, for good or for bad, that Chicago should be militarily occupied. With that hilarious video, I don't know if you caught it, of 10 Keystone Cop ICE guys, who are all good people, I'm sure, running like hell to try to catch an illegal immigrant food delivery guy in Chicago, to more serious actions in Portland and so on. This is not in the Constitution. So he's shown already that he is. It looks like he's ready for a fight with the Supreme Court. He's going to disregard them, or he's going to try to be tricky. And I think he's going to get flattened. I think it's called a constitutional crisis. Now, I originally thought this was going to happen by April, but it didn't. And although that Coney Barrett and a few other key Supreme Court guys are making noise, they are not happy with Trump's disdain for the federal judiciary. These stays and rulings, first, these emergency docket ruling decisions at the Supreme Court are not rulings. They're not reversals of lower courts' decisions, which have all been against Trump, by the way, every single one of them. And as this goes on, it seems what the Supreme Court's doing is just setting up so that when Trump responds in his rather Trumpian fashion, he has no room. And I think, though, that'll be a rather chaotic scene. I think it will. I think there's reasons why the National Guard weren't wandering around the worst areas of Washington, D.C., but they're right in front of the federal judiciary buildings and other icons of the federal government. This is scary stuff, and I don't think it's made for TV, drama. It's like he is doing this. So, okay, going back to the market, how to make money. I think more and more people, just from self-preservation thoughts or defensive positions, will start to think as I'm thinking, and they'll say, do I really have too much risk on? Is this market really going a forever market? Or maybe I got to cut back. And then as various events happen, like today's stay, our refusal to give a stay in the emergency docket by the Supreme Court for Lisa Cook, I think people more and more notice of this will be such that we'll have a cusp-like incident. He'll just go too far. He'll order National Guard to do something or other, and That was a pretty stony-faced audience that he had yesterday.
Yeah. So I guess what's difficult about a lot of this is that these are sort of sentiment teller. It's not as easy as say there's a corporate profit earnings play or something like that to attach a fundamental value to. You're trying to discount these very fundamental aspects of what makes the American economy so great. So I guess that's where, you mentioned that you use put options as a method to manage your risk, because the main outlay is the premium and you have that convexity in hand. So I just want to take together a few different tangents of ideas that you put together, which is that effectively we're in this regime where we had this very positive impulse, and now we have this very negative one. The writing's already on the wall, even if they were to reverse tariffs today. Plus, you have these additional tail risks that you've just been mentioning for the last few minutes on top of it. Therefore, the asymmetry is to the downside. It's just about trying to manage to get to that endpoint.
But the thing is that the downside move is not, it's not going to be discrete. It's not going to be like, okay, every week we get more information, so let's drop it a little bit or not go up anymore. It's going to be a jump. It's going to be like, holy shit, I thought we had corporate profits. That's what NVIDIA said. Well, they don't. And right now I have a slide up in front of you. It's corporate profits. The corporate profits, this is from the Bureau of Economic Analysis. It's not just the 7 heavyweights in the S&P's corporate profits or what they think they're going to get. This is the actual like money in, money out flow of funds, corporate profits for all of America. And they had already started in 2004, fourth quarter to stop, slow down. They've hit a wall of some sort. It's still a heavy number, but they've already started to come to a stop. And this is without considering tariffs. And if we look at a close-up, we can see that this is the Trump era. They've come to a halt. So I don't know, 70% of employment is not from like NVIDIA. It's from like the 7-Elevens and Chick-fil-A's and stuff like that. Corporate profits, they may carry on, but they've stopped. And this is without considering tariffs. Now, if I take a look at tariffs, oh, by the way, these corporate profits are after tax and they're after inventory adjustments. So, your inventory is depreciating. You didn't sell some stuff, so you got to take a hit on that. And, of course, taxes are taxes. So this is corporate profits net after taxes and inventory adjustments. Now, if we add tariffs dollar for dollar as a tax, there probably was more of a hit in the second quarter, which is the last quarter we have for corporate profits. By third quarter, we have if the tariffs show up in earnings, we've already dropped substantially, almost 10% in corporate profits. 10% it's a big number. And if we start to look at like just really rude scatter plots, this is corporate profits on the X. We're starting to approach 3 trillion, 3 or so, and this is the S&P 500 level. You can see that we're trundling along. It makes sense. There's a bit of a discussion here. This is the Trump scare in second quarter of this year. S&P goes down, but corporate profits keep grinding up. But we've hit a wall, and this is corporate profits are really not justifying any of the S&P expansion that we've had for about 6 months.
Got it. Yeah, because it's not translating to the right there either.
Yeah, but let me get more exciting.
Yeah,
this is S&P to corporate profits now adjusted for tariffs, and the wheels have fallen off. This has continued to go up. Corporate profits have taken a dive, and it's going to show. I mean, Ford's already saying that what I'm saying is right on. Every corporation that is not involved with like glorious days that are going to come out in the next 5 years, either from Starlinks to NVIDIA chips or what have you, they're all taking hits, and it's carrying on. So if that goes for the whole country. And this is the S&P 500 with a lot of the heavyweights are not involved with this story, but just to make a point, the wheels have come off, and we are just Wile E. Coyote spinning in air.
We do have to wrap this up, but I do think this is a really nice chart to end it on because it does aggregate everything we just walked through, which is, all right, we're in this situation where the fiscal tightening has occurred to create this compression of corporate profit margins, which is not effectively being discounted by equity. That is all it's a compelling case to make, George. I'm with you on a lot of that, and it's solid data. So hopefully there is a lot in there for people to digest and reconsider. Obviously, right now it just feels like it's a full-on bull parade. So yeah, I appreciate you coming on and walking us through that a lot. Hopefully, it gives some things for people to reconsider.
I think this isn't a reconsideration, Felix. This happened. That's the problem. So if you're
reconsideration,
if this is not
sentiment and narrative.
Yeah, if this is not your main act, if this is not what you take to heart, you got to come up with about it looks like 400 billion corporate profits to make me look ridiculous, or even to make me dismiss me. But what it is saying is that it has already happened. The door is already shut. And I would say, even to be a little abrasive, that you're pretty foolish to be long equity right now.
That's a great way to end it. George, I always appreciate that you're willing to stick your neck out in the bull direction and now the bear direction. Nobody will say that you are too biased one side or the other. So I appreciate it, and I appreciate you coming on to walk us through all of that.
Okay, and be a good sport. And if this all comes about, have me on to do a victory walk, will you?
Sounds good. All right, we'll do that.
Okay, talk to you.
All right, thanks, George.
Bye-bye.